In this video, I want to talk about the concept of echoing in trading. It's a very important concept you must learn if you want to become a professional trader. So this is a daily time frame chart of Pepsi, the concept of echoing in trading candlesticks. So let's try to understand. I will try to teach this concept to you. So as you can see here, the market is coming down and you have these two candles. Now, if you have knowledge of candlesticks, you can quickly identify that there are two patterns here. The first pattern is called as a bull harami. So, what is a bull harami? Is basically uh, the pattern comes after a downtrend. You have a tall red real body, bearish candle, and then the second real body is generally small. It can be any color, but it is completely engulfed by the prior tall real body. So it's called a bull harami pattern. Okay, remember it comes after a downtrend and it's a reversal pattern. What does reversal mean? Reversal mean that after this pattern, the market can either go flat or it can go up. The probability that the market will go down is very low. Okay, that's what a reversal means. The appearance of this pattern doesn't mean that the market will start to go up from here. Please remember that. Very, very important point. And the word harami is translated as pregnant. Okay, if you look at this pattern, you will understand why it is called as the harami. It's a Japanese term, and that pattern is very powerful. It's a powerful reversal pattern. Okay, it's a bullish pattern. Although both candles are red, but it's a bullish pattern. That is one thing. The second pattern that you see here is this single candle. This is called as a high wave candle. What is a high wave candle? Basically, it's a neutral pattern. Usually comes after a trend. It can be any trend, and it has a small real body, and it has tall upper shadow and lower shadow. So again, this pattern is echoing the bullish implication of the bull harami. So you have a bull harami, right? So it gives a bullish indication. It has a bullish implication. That bullish implication is confirmed by this high wave candle, because the high wave candle is saying that the prior trend is about to reverse. Reverse means either go like this or go like this. Doesn't mean that it will start to move up. Okay. So that is first level of echoing. The pattern itself is echoing the bullish implication or the bullish view that we have formed on the market. So let's look at what happens on the next candle. We would expect something bullish to happen. So again, you have a high wave candle, again a small real body and tall upper shadow and lower shadow. So again, this candle is simply echoing the bullish implication of the bull harami and the high wave candle. It is simply confirming the view given by this bull harami pattern. Okay, let's look at what happens next. We are looking for bullish signals so that we can think of initiating a trade. Remember, the bull harami is not a pattern where you initiate a trade. It's a pattern where you should close or partially exit a trade. So, for example, let's say you went short here. Somewhere in this area, you went short. You come down, you see this bull harami. You should close the position or you should at least partially exit that short position. That is the correct application of the bull harami. Okay. Coming back to the candlestick, let's look at what happens on the next candle. Again, you have this pattern which is called as a doji. If you understand candlesticks, it's a very, very powerful pattern. It has the same opening price and the same closing price. It's a reversal pattern. So what is it reversing? It is reversing the prior trend, right? You have another doji here. It's reversing the prior trend, correct? which means the doji is simply echoing the bullish implication of this bull harami. So you have three levels of echoing on this chart. One is coming from the high wave candle, another is coming from second high wave candle, and third is coming from the doji candle. All of these are neutral patterns. They indicate that the prior trend is likely to end. So it's all about probabilities. So they tell us that the probability that the market will go up is increasing candle by candle. So we are looking for bullish signals here. We have still not got a bullish sign which confirms our view that the market is indeed likely to go up from here. It would make sense to take a trade only when we know that the market is likely to go up from here, right? What if the market keeps consolidating? We are not going to make money there, correct? Let's look at what happens on the next candle. Okay, now we have confirmation. This is called confirmation. This is not echoing. Okay, these three candles were echoing the bullish view. This candle, the close of this candle provides the confirmation that our prior bullish view on the market was correct, right? So now aggressive traders could think of taking the trade. So you might want to go long here. You might want to keep your stop loss all the way here. So this is the entry point. You could buy shares here. This is the stop loss point. And way up here, you could keep your target. So if you measure this distance, right, project this distance upward, I think you have a reward to risk ratio of 2:1, right? That's a decent trade. So you have a 2:1 reward to risk trade available here. Something that would add to the probability that this trade would work out is, what if there was some support level here, right? Some prior support where the market touched this, went up. If all of these shadows, you look at these long shadows here, 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 if all of these shadows are confirming that support, it increases the probability that the market would go up. So that's why I said there are two types of traders: aggressive traders and conservative traders. So conservative traders might want to look for support, prior support confirmation. Aggressive traders might want to take this trade because they have been watching this chart candle by candle. Okay, so this view has been confirmed after each candle, and here you have the final confirmation. And let's say you put a trade here, you go long, you keep your stop loss all the way here. Look what happens. The market attains the target. I think on this candle, your target was hit. And if you observe this chart carefully, let's say you went long here. How would you manage the trade? If you look at this candle, there is no reason to exit the trade. If you look at this candle, there is even more reason to stay in the trade because there is a rising window here. Sorry, it's a gap in a Western technical analysis. This is called a rising window in Japanese candlesticks terminology. It's a continuation pattern and it further confirms our bullish view. Again, this is echoing the bullish confirmation given by this candle, and that's why it's even more reason to stay in the trade, not exit the trade. Okay, so this is a bearish engulfing pattern. I would not exit on that bearish engulfing pattern because you have a window here. So as you can see, candle patterns can not only help you take the trade but also manage the trade. Generally, people who do not have candlesticks knowledge, they might want to take a trade here and they might want to exit here because this is a bearish engulfing pattern. But people forget that there is a window here which is protecting that downfall. The chances that the price will cross the window is very less. And look what happens next. So it allows you to maximize your profit, right? And after some time, when you see this candle which negates the bearish implication of the bearish engulfing pattern. When you see this candle, you can immediately move your stop loss from here to here. So suddenly your risk has gone down. Now you can't lose money in the trade, right? Because you are already, your stop loss is already above your entry point. And then you can just stay in the trade for as long as you want, or till the trade hits your target. So as you can see, we have discussed many concepts here. We have discussed echoing, we have discussed window, we have discussed the Harami pattern, we have discussed doji, we have discussed high wave candle, then we have discussed the bearish engulfing pattern. So all of this knowledge, when you put together, you get a very good reading of the chart. And carefully notice, I have not even used any Western indicator here. There is no need to use any Western indicator if you have correct knowledge of Japanese candlesticks. And that is exactly what I teach in my Japanese candlesticks trading mastery program. Go and have a look at that. It has multiple levels of training program. Start with level 1. It will help you read the charts better.